Hi everybody and welcome to a fresh new episode of our Made for YouTube series. I'm Sumaira Abdi and joining in today we have Joydeep Sen, who's a corporate trainer and author, and of course one of our preferred guests when it comes to discussing anything about the bond market and its impact on debt mutual funds. And in fact, that's exactly what we'll be talking about today. Hi Joydeep, thanks very much for joining in. And, of course, the starting point for our discussion is the Reserve Bank's policy review, right? So though they did not hike interest rates, bond yields have still moved up. So, just want to understand what's happening over here and what is the impact on the bank depositors and also on borrowers.
Morning, Sumaira. So thanks for calling me like Bond 007. Okay, now on the question of the RBI policy review and the impact on bank depositors and borrowers, it is like this. Any market, be it the equity market, be it the bond market, be it the commodities market, works in anticipation. So what the RBI did last Friday is that, so there is something called the signal repo rate currently at 4%. That they have retained. Apart from that, they have given enough and more hints that they're going to hike rates going forward. Now, what are those rates? There is something called reverse repo rate, currently 3.35%. They have started something called standing deposit facility at 3.75%.
Right.
So effectively, they have hiked the corridor, lower bound of the corridor, from 3.35 to 3.75%. They have changed their stance from accommodative to withdrawal of accommodation, which simply means they are accommodative but less accommodative now, which means maybe in June review, they will move from accommodative to neutral. Also, the inflation forecast, it used to be 4.5% last review on 10th of February. Now it is 5.7% for FY23, as of now in the latest policy review. So all this means rate hikes are coming. So the market has reacted. So 10-year benchmark GSEC, which was like 6.9, 6.93 before the policy review, is like 7.1, 7.2%, 7.15% now after the policy review. And the markets have run up in anticipation of rate hikes. Now coming to banks, at the margin, we see a little uptick in bank deposit rates, but why only marginal? Because today banks have surplus money. They would rather say we would disburse the existing money first and then hike deposit rates. And on the loan rates, so the variable is important. So in case of floating rate bank loans, if the benchmark is RBI repo rate, that will not go up immediately. That will go up as and when the RBI hikes rates as such. So as an example, in June or August, you have the hike repo rate, then loan rates linked to repo will go up. Now there are floating rate loans linked to treasury bills. Now that is going up. So 3 months, 6 months treasury bill yields for some time it has been going up. There's something called VRRR, which is variable rate reverse repo, which has been pushing up money market yields. Now this change of stance that is pushing up yields. So that will go up to an extent. It's a matter of maybe 6 months to 1 year now, all these adjustments will happen. RBI will hike rates and deposit rates and lending rates will gradually move upwards to give real positive returns to bank savers.
Okay. All right. So, now, like you've indicated that the Reserve Bank has almost spoken about the rate hike, right? So does it mean that the returns from debt funds, which were already muted, will be even lower given that interest rates and therefore bond prices, will come down because of the inverse relationship?
Okay, that's a very relevant question. I would say it will not be even muted as such. It will be little muted for the next 1 year or so. Why? Just to explain how bond funds work, there is an accrual, which is the coupon rate of the instruments in the portfolio, which is intact. In fact, it is going up on the other hand. However, as you said, on the other hand, as and when bond yields move up, interest rates move up, and bond prices come down, there is an adverse impact. But the point is the market has already reacted. Like we just discussed, 10-year at 7.15% approximately now. The market has already reacted, which means as and when rate hikes actually happen, market reaction will happen, but not to that extent, which means there will be some impact of those mark-to-market impacts. So next 1 year or so, it will be somewhat muted, but not as bad, maybe marginally better than the last 1 year or so in terms of returns.
Okay, so like all markets, bond markets also move in anticipation of what is coming. So in this backdrop, which category of debt funds you think are preferable for investors now?
So the beauty of debt funds is it can be earmarked or laddered accordingly as per your time horizon. My time horizon so much, and there is an appropriate suitable fund. So be it 1 month, be it 3 months, be it 3 years, be it 10 years, there's an appropriate fund. So my favorite category is something called target maturity funds. There are plenty available in the market. maturities range from 3 years to 10 years. So as per your cash flow, like if it is like a 3-year requirement, 5-year requirement, 7-year, 10-year requirement, you can choose an appropriate maturity, target maturity fund.
Okay.
Apart from that, depending on your investment horizon, like if it is say 1 week or 1 month, you go for liquid fund. If it is 6 months, you go for low duration fund, or 9 months, 1 year, you go for low duration or money market funds. You can pick and choose as per the portfolio maturity of the fund and your investment time horizon.
Okay, so Joydeep, there is this view that the 10-year GSEC yield, which is the benchmark yield, has run up. And like you mentioned, it's north of 7%. So, is it time to invest in, say, long maturity funds?
Okay, so the classical wealth management, portfolio management theory says your investment should be as per your objective, your risk appetite, and your time horizon. It should not be about timing the market, because timing the market is like calling the level of Nifty or Sensex or 10-year or any benchmark for that matter, which is like anybody's call. Invest as per your objectives. So if you have a long enough horizon, you can invest in GSEC funds at any point of time. Now, having said that, like you just said, 10-year yield north of 10%, that is a somewhat better time, which means even if yields move up from now on, even if it becomes, say, 7 quarter, or let's say 7.5 for that matter, yields have already moved up. Just to give an example, May 2020, the last reported action by the RBI, 10-year was like around 5.8%. From 5.8 to 7.1, 7.15, it has already moved up. So we have that much better standing. And just in case somebody wants to trade, I don't recommend, but in case somebody wants to trade, there is something called constant maturity 10-year duration GSEC fund. So 4 AMCs have this product. So if you have a view that I'll buy 10-year GSEC fund at say 7.1, 7.2, 7.5% yield and offload at a lower yield level, that is possible. You can trade through this 10-year constant maturity gilt funds.
Yeah, so not to be confused, there is a gilt fund, and like Joydeep mentioned, there is another category, which is a 10-year constant maturity gilt fund. But, it's only for people who are savvy in trying to do this kind of thing. But, one more thing, Joydeep, is that, how much longer will the returns from debt funds remain muted? When is this tide going to turn for investors?
Yeah, I would say approximately 1 year from now. The basis of saying this is about 1 year from now, RBI should be done with the rate hikes, normalization, inflation going up, and real negative, real positive, all those things. RBI should be done. And also the market reaction, as in the market reacting to rate hikes or potential rate hikes, which means after a year from now, when everything settles, the portfolio accrual level will improve. So accrual will be higher and no further adverse mark-to-market impact. So maybe second or third year onwards, we're expecting better returns from debt funds.
All right, well, it's something to look forward to. So Joydeep, thanks very much for explaining how things move around in the debt market, because, it is still a little bit puzzling for most of us, but thanks very much for simplifying it. So there you have it, not much longer, debt funds will start, the returns will start improving at least a year from now. So thanks very much for watching this YouTube edition. I hope you learned something from it. It was beneficial for you, and we look forward to hearing your comments and suggestions, and if there are topics you'd like for us to take up in the future, we'd be very happy to accommodate those requests. So thanks very much for watching. Stay safe.